Hi everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. It's going to be financial topics, wealth building, and or commodities, because that's where I think the value's at in commodities. And we can show some value here. I think there's a chart or two that talks about some of the stocks and how overvalued they are, at least the big seven. So let's dive in here. Let's see what people are talking about, and I can share my financial opinions. If you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. You can use the word discount in the coupon code. And we have a 7 a.m. Mountain Standard Time Saturday question and answer session that's coming up. So we've got Chapter 11 bankruptcy filings jump to the highest level in 13 years. And we could see this also jump much like 2007-8. There is this occurring in the background. And I do think that this is going to eventually have an impact on the market. Oil prices have been coming back down. We've seen increased supply, and I don't think this is necessarily helping the demand side. These bankruptcies, credit card spending's declining. There are things that are definitely showing weakness in the market. And this could lead to a slowdown. Now, I know it's probably being hidden by spending that is occurring by the government. And this is where you've got two forces pushing each other, and I don't necessarily know what's going to win in the short term. That's where I keep getting tripped up, if I am going to get tripped up, is you've got competing forces, inflationary and disinflationary / deflationary forces that are hitting each other at the same time. And it's difficult to see which one will necessarily win out. I know the housing market is strong. I know construction spending is strong, and that's generally been a weakness in the market if those start to roll over, but they haven't rolled over yet. So you've got these forces all in the markets trying to balance each other out. You've got increasing rates, which are obviously having an impact on bankruptcy filings here, credit card spending, et cetera, et cetera. And then you've got the government that is spending money, whether it's deficits for whatever reason. So two contracting forces, opposing forces hitting each other, and we'll see how that works out in the end. We've got more disturbing news from Germany. German construction PMI cratered to 36.2 in November, approaching COVID lows. And, it's not just the United States that we should be looking at. There's also pretty big slowing in Europe. And this will also have an impact on some of the things that we watch from a commodity standpoint. This is way down in terms of PMI total activity index. 36.2, that is really low. So yeah, construction output is definitely down in Germany. Selling your stock on a double is a great way to lose out on a 10-bagger. That is true, depending on the market conditions and where the valuations are. I know some people have a set rule. They say, I don't care what I'm going to do. I'm going to sell when it doubles. Sometimes what you can do is put it into a free ride. I haven't talked about that in a while. If your stock doubles and you think that the market conditions are not as ripe as you would like, you could sell half of it, take your original money out, and then let the stock go into what I consider to be a free ride. It is your profits riding only. So if it goes on to be a 10-bagger, you've protected your original capital, and you've put the stock into a free ride where if it goes way up, well, then it just continues to return to you in your portfolio. I tend to try to ride the long term and not try to time the short term market movements. I don't think that anyone can accurately predict short term market movements. That is why I do long term investing, the decade plus type approach. That's also why I do a lot of technical analysis on the long term. I only do the short-term daily updates as people wanted me to do that because they wanted to get updates on a daily basis and do more of the short-term stuff. But I do not try to time the short term at all. I try to time my entry points as best I can. And I think that's about all you can do from an investment standpoint. I don't think you can play the short-term market movements. Almost everyone has gotten their clock cleaned on a short-term time frame. So the Warren Buffett types, the Peter Lynch types, the Jim Rogers, and all those guys, they just wait for a gigantic valuation gap to occur in the market. Then they pounce on that valuation gap and then sit in it for a long time. And that's how they usually make vast amounts of money. And then when that valuation becomes rich, then they sell it. Or sometimes they never ever sell it, depending on the stock type it is. Warren Buffett advocates to buy very well-run companies with moats around it at very good opportunities and then never sell it. That is his outlook. And he says to hold it for your whole life, if you can, if you don't need the money. That doesn't apply to cyclical stocks like commodities. That's why we have the ratios. But that's kind of how I look at it at this time. So coming down, we've got Transocean Rig forms the death cross for the first time this year. What that is where you get a shorter moving average, like a 50-day moving average, closing on the 200 on coming back below. And sometimes you get whipsawed back and forth. You can obviously see this has been whipsawing back and forth. But I don't, we got this inflationary impulse move from a lot of stimulus in the market, also from bank lending in 2020, because the housing market was ripping pretty good in 2020 and 2021. And we are getting a slowdown. Bank lending has pulled back, and it's going to have an impact on some of our oil equities. So I'm riding through this beast. We've got these opposing forces, and it's very difficult to get a clear read on what is driving what. Generally, if you've got the real estate market, which we've got home builders moving up quite dramatically, sales volumes have definitely pulled back, and same with bank lending. But I think that's going to pick up with lower interest rates, and that's really what I'm watching. Every time we've had high home sales volume or increased bank lending and increased housing starts, and housing starts have held they've been quite resilient in this slowdown because the housing market is in such a shortage. I know people try to debate that, but they are wrong. That's why we have low inventory and housing starts are high. If we didn't have that, we would have a bunch of inventory. So they're trying to spin something that doesn't exist, in my opinion. But every time we've had housing starts go up, and every time we've gone into this increased lending period, we've had inflation and increasing oil prices. That's basically where the deficit or shortage comes from. There could be a different dynamic this time around, no doubt about it. And that dynamic is based off of the credit cycle and the deficit spending that occurs from interest payments and stuff like that with the debt. Coming on up, expected returns over the next decade, fingers crossed for the Magnificent Seven. All this is telling us is that whenever you get a PE ratio of this valuation, which is basically off the map here, that your expected returns over the next, what is this? I think this is probably the next 10 years or so. The forecasted return would be something like minus 10% over that period. So the normal PE ratio is around 22 times. A very cheap ratio would be something like 10, would be almost unheard of. But we're over here at like 36, 37, which is very, very expensive. And historically, that's been poor returns in the future, given that type of rich valuation. So the way that you'd want to do this, if you wanted to play the S&P 500, if you wanted to play the valuations the way that I do it, is I look for very cheap valuations. The PEs that we are investing in on the website, some of them are like 2, 3, 4, 5, which is off the chart for this particular chart that they've got here. So we're investing in these value stocks, and the potential returns are greater. You can see how this is the linear regression analysis here. It's way up here. So your valuations are off the chart. Now, if you get a commodity to go up during that same time frame that your PE ratio basically richens up, that's where your valuations change dramatically, and that's where your stock price goes way, 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 way up. That the PE ratio generally catches up when the commodity price goes up. So not only are their earnings going up, they're going up faster than their earnings are going up because you're also adding to that richer valuation. That's where you get the big 10-bagger gains. You go from a very undervalued state with potential weaker earnings to a very strong earnings with the commodity price going up and richer valuations on top of it. That's what we're going for. It says, I've been investing in the stock market for almost 2 decades. If I had my first $1,000 to invest, here's exactly what I would do. She says, do it yourself. You have a choice to invest in your own or find a financial advisor. Investing doesn't have to be complicated. Find a large discount brokerage and open an account. There's so much research available these days. Know your risk tolerance. When your emotions drive your investment decisions, you're going to sell too soon. Gauge your risk tolerance and find investments that align to it. You don't want to lose sleep over your investments. Learn about stocks and funds. Know what you're investing in before you make the purchase. Do your research on the brokerage's website. Dollar cost average. Divide up your $1,000 and put it in $250 over 4 to 8 weeks. Don't stop at $1,000. Make this a new habit. Be consistent and patient. So I agree with the majority of what she is saying. What I would say is find where the valuation. So first, obviously, open up a brokerage account, learn about investing, etc., etc. If you're going to play the individual stock game, you need to find the value in the market. Where is the gap? And then you want to exploit that gap, that valuation gap. You want to buy it when something is cheap and the market's mispricing it. Or if there's max fear in the market. If there's max fear in the market, that's where your valuation gap exists. They sell it way off, everybody gets fearful, and they create the valuation gap. That's how you do it. That's how Buffett does it. That's how Peter Lynch does it. And then they hold on for very long periods of time. That is exactly what I'm trying to practice myself. I find gigantic valuation gaps in stuff that has been underinvested and underowned in the markets. I buy it when the charts look pretty good, and then you sit in them. You sit and you wait. It's very hard to sit and wait for most people. They don't have the conviction. They don't know maybe necessarily how good the valuation is. Like they don't understand it. And that's where you have to be. You have to understand that you are in a very undervalued stock in an undervalued sector where not many people own it. And then you're waiting for that money rotation to come back into it because the market is going to see a supply-demand deficit in whatever you're investing in if it's a commodity. That's really what it does. And at some times, you get these flows, these cross currents as you're investing. So the market conditions, they're right for it. So we go way up, then we get a pullback because the market condition can change. We get a slowdown in the market, a recession, a pullback, something like that. And then you have to wait for that other impulse move of inflation to come. That's basically what we're waiting for right now in commodities. We're waiting for that next impulse move of inflation to come. That generally comes from bank lending, and that bank lending comes against new homes being built. And that is still looking good in terms of the market conditions on that front. But in the short term here, we are getting a slowdown between that. I think interest rates probably went to a level that may have not been as sustainable for the real estate market, and it slowed things down. It says, every analyst was wrong on the way up. They never thought rates would go as high as they did and stay as long as they have. How wrong will they be with this guess in 2024? Now, the guess is the Federal Reserve will cut interest rates 6 times in 2024 as the economy shows clear signs of cooling down, ING has said. The thing to keep in mind here, guys, is that there's very few things that people predict and they get right. There is very, very few things. So what you want to do as an investor is you want to say, what are the things that I can control? And what are the things that are given to me as information today? So if someone says, we have a very cheap oil to gold ratio. So you say, okay, I know oil is cheap. We're just waiting for a potential bottom. We know silver's cheap. We know platinum's cheap. We know a lot of these commodities are cheap and under-owned. You can't control and predict necessarily where things are going to go in the future. But what you can do is you can create a portfolio that is well undervalued, where the value of the portfolio is and the stocks that you own are undervalued. And undervalued means they're cheap and that they're out of favor. And then you just have to wait for that market condition or that in favor for people to change their mind and slowly invest in it for whatever reason it is. That's how almost every single investor has made lots of money. They find a valuation gap in the market, or even a business. They find a need. They find a spot where they can undercut other competition, wherever it is. They enter it, and then they perform during different market conditions. So many predictions be like housing prediction, 2019 crash, 2020 crash, 21, 22. It's this crash of every single second that people are predicting. And be careful, predictions rarely come right. The destruction of growth model, Germany's factory orders have grown in just 1 out of 20 months on an annual basis. Orders fell by 3.7% from the previous month in October, so they are struggling over in Germany. And that's going to have an impact on some of these commodity demands worldwide. If Europe is struggling, I mean, that is reduced demand, and they are a big portion of demand. Crude oil, it says crude oil continues to get obliterated as it falls below $70 per barrel for the first time since early July, and it does look pretty weak in the short term. We are still above major support levels. The major support levels are probably around $65 a barrel. And it does look like we want to go tag up on $65 a barrel here at some point. Tavi says, investors who have been spooked by the recent decline in gold after making new highs are missing the big picture here. Fundamentally, nothing has changed. We're on the verge of initiating a prolonged cycle for precious metals, and the recent volatility should be viewed as an opportunity. This is a unique period where gold is leading the way and all other assets strongly correlated to the metal remain historically undervalued. He's talking about commodities. To be clear, this is not the time to be bearish on other precious metals and the miners. That was the right call a decade ago. And here we are, ready to move on up. We're starting to break some resistance lines. There's other information that we know, Tavi and myself, in terms of declining supply, increased demand, the inflationary decade that's coming, all of the charts, the technical charts we look at, the producer price index divided by the S&P 500. It goes on and on and on and on. It all aligns with higher gold pricing. And now is the time to be bullish, not to be bearish, because of the market conditions. He is completely right. Christmas gift, silver needs to close above $28 to get a yearly confirmed breakout in terms of this gigantic cup and handle on a yearly basis from 1970s. This is the biggest chart pattern that I think I've ever seen of anything. Hopefully we get a big break here and we are off to the races with gold and silver heading higher. But maybe the next year's close is what we're going to find to be above 28. Maybe it's not this year. Cuppy says, bottom, I'm selling all my oil stocks and becoming a Democrat. Obviously, he's joking. Gold, it's only one way up, up, and away. And we've got a breakout, a retest, and a potential move up with this trend line, resistance, support line. It's acting as support at the moment. And we're looking for a move to the upside in gold and all of the other precious metals that are tied with it. And eventually, as gold goes up, I think there'll be a reaccounting of commodity pricing as well later on in the future. Gary says, funny that many liberals seem to think fossil fuels are bad, but socialism is good. They should try living without oil and with socialism for a while. Home prices are contracting sharply, but they aren't contracting because he's using the wrong measurement stick here. This is the median home prices are contracting sharply. That is true that the median home price has gone down, but that does not mean that the same home actually went down. What that means is that the median, the middle home price, has pulled back because they're building smaller homes. And the volume of smaller homes has gone up. So your middle price of that data set has gone down because they're selling more smaller homes. Home builders continue to rocket higher. Livermore accumulation cylinder about to explode higher, question mark. Regional banks also have the same cylinder, which is the loaning portion of it. So XHB is starting to break its all-time high here. And maybe we're going to rip it to the upside. That is very good for home builders. And that's also very good for inflation with the loaning that goes against those homes. So how could the median home price index fall, but at the same time, all the home builders are rocketing to new highs? It's because we have a shortage in the market. And with interest rates coming back down, people are positioning in home builders for that move. Every time we've had these big home builders go into an expansionary phase, which we're going into and are in, we've had big commodity price spikes during those timeframes. So the only thing that I don't know is, do we have to cycle back down in the short term for the inverted yield curve, get a slowdown in the market, have interest rates come back, and then the inflationary surge resume when those interest rates come on back? I think that is the case, but again, I don't know the future. And this is the regional banks. This is also an accumulation cylinder that's starting to work its way on up. So that's something to watch if you're not watching it already. Oil services sector is down 20% from its September peak and testing 200-day moving average. Volume has been declining in recent things, and this did break to the downside here today. So we could see further downside in OIH and some of these other energy service companies down to maybe 280 or so, 275, 280. Permanent job losses have accelerated to the upside. It says this indicator is spiking equals a recession. Permanent job losses are rising aggressively. That does seem very concerning. The only thing I will say is, I know there's a lot of job openings, and maybe the economy needs to rotate where jobs need to be. It needs to rotate away from certain sectors and towards other sectors, and the skill sets may not line up very well. So that is one thing that we are seeing, is more permanent job losses coming on up. Here's Gary. I wanted to read this. He says, most traders never make any serious money in the markets because they don't have the patience to hold long-term positions. Big gains more often than not take a long time to build, and there are scary corrections along the way. One could have bought and held at any of the last 4-year cycle lows and made great money. How many people did? Probably almost no one. The 8-year cycle low in gold occurred in October of last year. Those who bought, or those that bought and can hold through all the ups and downs, are going to make gains comparable to those long-term gains in the stock market over the next several years. How many people will hang on for the full ride? Almost no one is my prediction. The way to do it is to buy physical, because you can hold on to it. Now, what he's talking about are these major cycle lows: 09, 2011, 2016, 2020. I bought the crap out of platinum in 2020 at this cycle low. I also bought the crap in 2016 low for silver. And I've been holding the entire time. I can remember buying silver in the 14s and very low premiums. Dollar something premium for American Eagles even. I can remember the premiums got jacked in 09. Premiums also got jacked on silver in 2020, but there were very low premiums in platinum. So that's where I loaded up. I also loaded up as this was falling. I grabbed some ounces of silver as well as it was falling, and then they jacked the premiums up shortly thereafter. But yeah, holding on to these big cycle lows is where you make all the money. Now, if you bought in 09 and you just held the entire time, holy crap, you'd make so much money. This is the S&P 500, by the way, just to let you know. But gold's the same way, guys. Gold is the same way. If you buy these cycle lows and you just hold on, it's not a big deal. You're going to make a lot more money than trying to trade the short term. And that's where I'm going to end it, guys. So that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. And we're seeing some slowdown in the markets. That's for sure. Hopefully, it's just tax loss harvesting at the end of the year. It's difficult for me to say. We've got opposing forces really hitting each other at this time. We got deficit spending, fiscal spending, and then we've got slowdown in the market in some areas. And they are hitting each other right now. So that's what I've got for today. Hopefully you guys are having a good day. Catch you later. This is Finding Value.